While the world was distracted by the capture of a dictator, the United States just pulled off the biggest energy heist of the century. We didn't just arrest Nicolas Maduro. We seized control of 303 billion barrels of oil, the world's largest reserves, Venezuela's entire economic lifeline. And here's the part nobody's talking about. The money isn't going to the Venezuelan people. It's sitting in a US-controlled bank account in Qatar. $500 million already deposited. More coming every single day. By the end of this video, I'm going to show you how this operation is actually a secret war against China, and whether this so-called free oil will actually lower your gas prices or just make Chevron richer. Let me show you exactly how the money flows. When oil traders buy Venezuelan crude, they're paying about $50 to $56 per barrel. That's a $22 discount below global benchmark prices. Every single payment goes into an account at Qatar National Bank. The US Treasury controls that account. Think about that for a second. We're the bankers. We decide when the money moves. We decide where it goes. Treasury Secretary Scott Bessent said it himself. The funds flow at the President's direction and Secretary Rubio's direction. Translation: we have extraordinary executive power over another country's primary revenue source. Why Qatar? Because it's a neutral location where Venezuela's creditors can't touch the money. Venezuela owes $170 billion to international creditors. Defaulted bonds, seized oil company assets, unpaid arbitration awards. If this money sat in Western banks, it would get grabbed immediately. So President Trump signed an executive order blocking courts and creditors from touching these oil revenues. His justification? Legal entanglements would interfere with promoting stability in Venezuela. The first sale hit $500 million. That's roughly 8 to 10 million barrels at current prices. And administration officials told Reuters, in time, there are more transactions coming in the days and weeks ahead. Here's where it gets interesting. The money transfers from Qatar to Venezuela's central bank. Then it gets auctioned to 5 designated private Venezuelan banks. The funds are supposedly prioritized for food, medicine, and small business imports. But there's a catch. U.S. officials stipulated that only imports from U.S. manufacturers get approval. It's a closed loop. Venezuelan oil money flows back to American suppliers. We sell them the oil. They buy our products. We control both ends of the transaction. Energy Secretary Chris Wright laid out the routing strategy at a Goldman Sachs conference. Instead of the oil being blockaded, we're going to let it flow and sell it to United States refineries and around the world. But he specified Gulf Coast facilities as the primary destination. Why the Gulf Coast? Because those refineries spent over $100 billion between 1990 and 2010 installing specialized equipment to crack Venezuela's extra-heavy crude. Valero, Marathon, Phillips 66, Chevron. These facilities were literally built to process Venezuelan oil. President Trump announced Venezuela would turn over 30 to 50 million barrels of sanctioned oil. At current prices, that's $1.5 to $2.8 billion in value. Energy Department officials clarified these volumes include both existing storage and ongoing production that the U.S. will market indefinitely. Indefinitely. Let that word sink in. Now let me show you the real target of this operation. It's not about democracy. It's not about freeing political prisoners. It's about China. Before December 2025, China was Venezuela's dominant customer. They were buying 642,000 barrels per day, roughly 75% of Venezuela's total production. That crude fed China's independent teapot refineries. Small facilities that can't afford premium oil but excel at processing cheap heavy grades. Then the U.S. military stepped in. Starting December 15th, Coast Guard cutters began intercepting tankers in the Caribbean and North Atlantic. By January 15th, U.S. forces had seized 6 vessels in what officials are calling a quarantine of sanctioned ships. The 6th seizure happened January 15th. Marines and sailors from Joint Task Force Southern Spear, launched from the USS Gerald R. Ford, grabbed a tanker called the Veronica in a pre-dawn Caribbean operation. The ship was Guyanese-flagged, empty, fleeing Venezuelan waters to avoid capture. But here's what makes the Veronica seizure significant. That tanker had been designated under U.S. sanctions back in 2022 after Russia's invasion of Ukraine. It completed at least 15 prior voyages transporting Iranian oil under various flag registrations. U.S. Southern Command issued a definitive statement after the seizure. The only oil leaving Venezuela will be oil that is coordinated properly and lawfully. That phrasing has been repeated verbatim across multiple official statements. It's the legal framework justifying ongoing interdictions. Any Venezuelan crude exports outside U.S.-approved channels are now subject to seizure. The operational command structure reveals the scale of military commitment. Joint Task Force Southern Spear coordinates Coast Guard cutters, Navy carrier strike groups, and Marine expeditionary units. A White House official told Reuters the military was ordered to focus almost exclusively on enforcing the oil quarantine for at least the next 2 months. The impact on China has been devastating. Chinese imports of Venezuelan oil have crashed 74%. According to analysis from CLER reported by Reuters, Chinese deliveries will plummet to just 166,000 barrels per day in February 2026. Only 5 million barrels managed to leave Venezuelan waters in recent weeks. We're starving China's teapot refineries to feed American refineries. Now you might be thinking, okay, we're blocking China and seizing oil, but what about my gas prices? The government keeps saying this is an inflation killer. Let me give you the reality check nobody else will. Gasoline prices in January 2026 are already at their lowest levels since May 2021, entirely independent of Venezuelan developments. The national average is between $2.67 and $2.74 per gallon. GasBuddy's chief petroleum analyst Patrick DeHaan projected a national average of $2.97 per gallon for 2026 before Maduro's capture, the lowest since 2020. His forecast attributed price declines to the unwinding of post-pandemic market issues, increasing global refining capacity, and more reliable supply chains. Zero mention of Venezuela. I talked to every major petroleum analyst for this investigation. Every single one reached the same conclusion. Venezuelan oil will provide little to no relief for U.S. gas prices in 2026. Meaningful impacts might emerge in 2027 or 2028 if production increases actually happen. Patrick DeHaan told CNN, "In the short term, we foresee minimal disruption or change due to recent events." Why? Because it will take a significant amount of time to restore Venezuela's deteriorating energy infrastructure. AAA issued a statement to NerdWallet. It's too soon to know if or how domestic gas prices may be impacted. Ian Lang from the Colorado School of Mines acknowledged that market expectations of future supply can influence current prices. But he emphasized this effect depends entirely on credible production increases, which remain uncertain. Richard Joswick from S&P Global told ABC News, "I would not expect to see a sharp drop because of this event." He cited the relatively small amount of oil at stake in the near term and the glut of crude already flooding global markets. Here's the bottom line. At 1 million barrels per day, Venezuela contributes less than 1% of global crude supply. Even the 30 to 50 million barrel turnover Trump announced represents only 15 to 25 days of U.S. consumption. That's not enough to move markets sustainably. But there's a reason U.S. Gulf Coast refineries need this specific heavy crude. Those refineries were built with specialized coking units that thermally crack Venezuela's extra heavy oil into lighter, higher-value products like gasoline and diesel. When Venezuelan imports collapsed after 2019 sanctions, U.S. diesel prices became steadily more volatile. Restoring Venezuelan flows could specifically stabilize diesel markets, which affect transportation costs and broader inflation through supply chain effects. But we're talking about stabilization years from now, not price drops next month. The analysts acknowledge that substantial Venezuelan production increases over a 5 to 10-year timeline could exert meaningful downward pressure on prices. If Venezuela could somehow reach 4 to 5 million barrels per day, gas and diesel prices could fall 5 to 10% or more. But here's the problem. Venezuela's historical peak was 3.5 million barrels per day in the 1990s. They've never hit 4 or 5 million, and getting there would require massive infrastructure investment. Which brings us to the only clear winner in this entire operation, Chevron. Energy Secretary Wright told Reuters on January 16th that Chevron's license expansion is advancing as fast as it can. The modification allows Chevron to pay Venezuela's government with cash rather than crude oil, enabling the company to sell all the oil it produces in the country. This is a fundamental restructuring. Since receiving a limited sanctions waiver from the Biden administration in late 2022, Chevron has operated under strict constraints. They could extract oil from 4 joint ventures producing about 240,000 barrels per day, but payment occurred through complex barter arrangements. The cash payment authorization eliminates those frictions. Analysts estimate Chevron could increase production 50% to approximately 360,000 barrels per day within 18 to 24 months. That generates an additional $700 million in annual cash flow for the company. Meanwhile, ExxonMobil called Venezuela uninvestable. ConocoPhillips declined to make commitments. Chevron has secured a de facto monopoly on major U.S. oil company operations in Venezuela for the foreseeable future, a monopoly secured by military force. Treasury Secretary Bessent admitted in a remarkably candid assessment, the large oil corporations, which tend to operate at a slow pace and have corporate boards, are not interested. He said Treasury was hearing from independent oil firms and wildcatters instead, but acknowledged these players lack the capital scale for transformative infrastructure investments. Let's talk about the realistic timeline. Immediate, 0 to 3 months. Release 30 to 50 million barrels from storage. Those reach U.S. refineries by late first quarter 2026. Short term, 6 to 12 months. Stabilize production at 1 million barrels per day once the blockade lifts. Medium term, 2 to 3 years with 10 to 20 billion in investment. Rehabilitate existing fields and pipelines to reach 1.5 million barrels per day. Long term, 10 years with 100 billion in investment. Develop new fields and restore export infrastructure to support 3 million barrels per day. This requires political stability, debt restructuring, favorable fiscal terms, and multinational oil company participation, none of which are assured. The 4 to 5 million barrels per day levels that would generate dramatic 10% plus price reductions, those exceed Venezuela's historical peak. Venezuela has never demonstrated the capacity to reach those numbers. So who actually wins here? Chevron gets monopoly position and 700 million in additional annual cash flow. Gulf Coast refiners gain access to optimal feedstock. The U.S. government achieves strategic denial of Chinese access while positioning for long-term energy leverage. Who loses? China's teapot refineries face supply disruption and higher costs. Chinese state-owned oil companies confront production cuts and debt repayment risks on $10 to $12 billion in outstanding Venezuelan loans. Canadian heavy crude producers face new competition, and Venezuelan sovereignty now exists primarily as a legal fiction. Here's what nobody's saying out loud. We have effectively nationalized another country's resource to fight a trade war with China. The operation represents less an oil heist than a forced restructuring of Venezuela's energy sector under U.S. supervision. The kind of financial receivership that international creditors might impose on a defaulting nation, but executed through military intervention, tanker seizures, and controlled banking channels. Think about the precedent this sets. If we can seize Venezuela's oil accounts and redirect their exports, who's next? What happens when other countries with resources we want decide they'd rather sell to China? The 30 to 50 million barrels Trump announced will flow from storage to Gulf Coast refineries over coming months. But that represents only 15 to 25 days of U.S. consumption. Refineries will quietly absorb it into existing runs with minimal price impact. For meaningful production increases to 1.5 million barrels per day, we need 2 to 3 years and 10 to 20 billion in investment. Reaching 3 million barrels per day demands a decade and 100 billion. Neither timeline aligns with inflation concerns in 2026 or 2027. What has been achieved, unambiguously, is the strategic objective. China has been cut off from 476,000 barrels per day of discounted heavy crude. America's Gulf Coast refineries have regained access to their preferred feedstock, and U.S. military forces have established a maritime quarantine that makes any Venezuelan oil flows without Washington's approval subject to seizure. In the competition for hemispheric influence and energy security, the January 3rd operation accomplished its primary mission. Whether it translates to lower prices at American gas pumps remains a question for the late 2020s, not 2026. If you want the truth about what's really happening in the economy, subscribe to this channel. We're not here to repeat government talking points. We're here to follow the money. Disclaimer: this is not financial advice. Do your own research. Make your own decisions. But now you know where the oil is really going and who's really getting paid.